If you're the founder or managing director of an Indian mid-market enterprise generating between 50 crores and 500 crores in annual revenue, you're currently bleeding enterprise value. I'm Vishak Ganti, the managing director of Business Factory. We engineer corporate architecture and exit strategies for traditional Indian businesses. Today, we are examining the SME tax trap. For the last decade, you have run your balance sheet with one goal: minimizing your tax liability. You have aggressively depreciated assets, run personal expenses through the corporate structure, and kept your compliance strictly at the surface level. This strategy works perfectly for survival, but the moment you attempt to trigger a liquidity event, whether that is a private equity buyout, a strategic acquisition, or raising tier 1 capital, that exact same tax strategy will cost you 20% to 30% of your final valuation. When institutional capital looks at your firm, they do not look at your potential. They look at your risk surface area. When a big four due diligence team enters your data room, they are hunting for structural inefficiencies. If your cap table is a mess of undocumented family equity, if your intellectual property is registered to the founder instead of the holding company, or if your EBITDA is artificially suppressed by unstructured director payouts, the private equity firm will not walk away. Instead, they will weaponize your disorganization. They will use your compliance gaps to justify a massive discount on your multiplier. You will sell a 200 rupee crore asset for 140 crores simply because your corporate architecture was fragile. At Business Factory, we do not allow our clients to enter a negotiation in a defensive posture. Before you ever sign an NDA with a buyer, you must execute a preemptive internal audit. We deploy a strict three-phase protocol to militarize your enterprise value. First, EBITDA normalization. We forensically rebuild your last 3 years of trailing financials. We strip out the non-recurring expenses, the optimized tax write-offs, and the redundant family payroll. We calculate your absolute true operational cash flow. If we can legally add back 5 crores to your EBITDA and your industry multiplier is 8x, we have just engineered an additional 40 crores in enterprise value for you out of thin air. Second, cap table and UBO cleansing. Institutional capital requires friction free equity transfers. We restructure your ultimate beneficial ownership, ring fence your core operational assets from your real estate holdings, and ensure your IP is immaculately registered to the correct corporate entity. Third, the preemptive VDR. We do not wait for the buyer to ask for documents. We build an encrypted virtual data room containing your normalized financials, absolute legal compliance, HR contracts, and vendor agreements. When the buyers analysts log in and they do not find a disorganized SME, they find a lethal institutional grade corporation. You dictate the terms of the data. This architecture is not for early stage startups and it is not for the founders looking for a quick exit. This is exclusively for traditional Indian businesses preparing for tier 1 liquidity events with the next 12 to 24 months. We do not work with everyone. We do not accept high volume clientele. If your enterprise fits this precise criterion and you recognize the mathematical necessity of militarizing your corporate structure before facing institutional buyers, you'll find a secure email address in the description below. Have your chief of staff forward a brief executive summary of your current operational scale. If there is a structural fit, we will arrange a highly confidential 15-minute diagnostic call. Do not go to the negotiating table unarmed. Good day.